Thank you for watching. This video is primarily intended for young adults and couples who want to know how to handle the myriad financial demands of independent living. Methods for managing personal finances have changed over generations because of continuous evolutionary changes in banking technology, which affect every aspect of personal and business finance. While many of the changes in technology have made it easier for people to go shopping, those same changes have made it easier to get into financial difficulty. Unfortunately, many parents can't teach their teens how to manage their finances effectively, and high schools rarely teach students more than the basics. The lack of basic personal financial skills, especially in the areas of budgeting and managing credit, affects everything from living independently to work to relationships. Because talking about money is so personal and sensitive, this lack of financial literacy is rarely addressed. For that reason, we made this video to help viewers understand how to avoid the most common financial challenges before they occur, and to see how to regain control after encountering the most common financial challenges. So, what's our approach? Family counselors have told me many people, including married couples, experience anxiety over their finances because they feel they have no control. It's often a source of friction between couples. One family counselor asked me if I could help their clients in separate sessions to understand how to regain control over their finances. That request was the genesis of this program and subsequently this video. During my MBA program many years ago, we were introduced to the Japanese philosophy of Kaizen, which contained two starting paradigms. You cannot control what you cannot see, and you cannot improve what you cannot measure. Those paradigms don't just apply to Toyota building cars, they apply to every one of us if we understand that we are managing a business at home. And our personal finances are fundamentally no different than any business. Those paradigms are key to gaining control over the financial aspects of your life. So, what brings you here? Has this happened to you? One thing we hear regularly is that people get surprised when their ATM doesn't give them money when they think they have enough, or their debit card is declined for insufficient funds. It's also quite common to hear how the bank screwed things up. When I ask how they track their money, the most common answer is, I look at my app on my phone. Occasionally, I ask if they know where they spend their money each month, and I often get a blank stare. Remember the paradigm? You cannot control what you cannot see. Personal finances for adults encompasses all these topics. For many adults, monthly income from their job is a predictable amount based on working a similar number of hours each month, or from a fixed salary. That income has to cover all living expenses, and managing cash flow becomes even more challenging for couples with only one income. If we never spent money that wasn't in our bank account, we would not use credit cards or have loans for the larger purchases. But we all need a car or want to buy a home. So we have to finance those things over years. Almost everyone charges Christmas and birthday presents to make children happy or to go on vacation. Credit card and mortgage payments are a regular expense that cannot be deferred. Managing all these normal expenses requires a methodical approach to controlling spending. We broke this video into 4 sections covering the basics of personal banking, what is a budget and what does a budget look like. Then we go into credit, how credit ratings are reported, and why your score is important to you. And finally, we specifically address an approach to tracking your income and expenses that will enable you to see your cash flow and exercise control over your personal finances. Understanding your cash flow simply means you have a sense for the sequence and timing of all your deposits, withdrawals, and spending transactions that go through your bank account. If every deposit, withdrawal, or spending transaction was digitally processed instantly, your banking application would always show you the correct available balance. While ATM withdrawals post immediately, that is rare for payroll deposits or spending with merchants and restaurants. The inherent delays between the actual transaction at a merchant or a restaurant and the posting of that transaction to your bank account mean the available balance you see online or on your cell phone app is usually higher than what you really have available because the bank's computer cannot see business transactions that have not yet processed through the interbank network. We'll look at some examples in the next slide. Your end of month statement is the official record of your cash flow through all of your banking accounts. I took a screenshot of my own checking account a few years ago for a previous version of this presentation. Your bank's presentation of this information may be different, but the transaction information will be somewhere for you to see. Along the left side, my bank shows me the date a deposit or withdrawal transaction posted to my checking account. If you look closely at the transaction details in the center, you can see the withdrawal was from a debit card transaction or an ATM withdrawal of cash or a check that processed. In those details, it shows when I used my debit card with that merchant. Notice the merchant category codes at the end of each item. We'll talk about them in a bit. Now, compare the different purchase dates in the details to when my bank posted the transaction and deducted the amount from my account. A few were on the same day. Restaurants are almost never the same day. And if you are someone who still uses paper checks, there is no way to guess the length of delay from you giving a check to a merchant to them depositing it in their own bank account to that check being processed by your bank. To effectively manage your cash flow, you need a way to know which transactions are still in the pipeline and have yet to process. We'll show you how later in this video. You cannot rely on the automatically assigned categories in your online accounts. This screenshot shows some examples of disparities. The top entry was for a belt purchase, but the system assigned category was travel. My payments to Roku for streaming Acorn and BritBox were labeled as utilities instead of entertainment, while my Amazon purchase of Maxwell House flavored coffees was categorized as entertainment. The transactions with the green check mark were correct, but the merchant category code, or MCC, you saw on the transactions in the previous slide caused these mislabeled transactions with red underlines. Amazon was originally a bookseller, but now it sells everything. But everything it sells is categorized as entertainment. We'll show you a better way. Let's move on to budgeting. First, let's give it a definition. It's nothing more than a listing of expected cash flows, i.e., income and expenses during a specified period, like a month or a year. Because we're talking about cash flows, income is the net income that gets deposited into your bank account. When developing a budget, it's important to distinguish expenses that are the same every month, like rent and car payments, and which ones vary every month, like food and utilities. Equally important is distinguishing mandatory expenses from discretionary ones. Mandatory expenses are not optional and must be paid, while discretionary expenses are for nice-to-have things like entertainment or going out to eat. When you subtract all planned expenses from your net income, what is left is for emergencies and possible savings. So, how do you start building a budget for yourself? Let's take a look at one method as an example. This task is much easier if you have already been tracking your spending and know how to use spreadsheets like Excel. On the left side, you see a blank template, which is where you would begin. At the top, under income categories, enter how much you get paid each month and where it comes from. If you have two jobs, list them separately. This is usually the easiest part. Then, make a list of all the things you normally pay for under the expense categories. In the amber column, next to each expense category, enter a Y or N for yes or no to indicate whether you consider this category to be a mandatory expense. Next, enter in the month column how much you spend in that category each month. Some things, like rent and insurance, might be the same every month, but others will vary each month, and some might be paid every few months. The monthly columns will enable you to distinguish differences, and once complete, the annual column will enable you to divide by 12 to get a monthly average for that category. The graphic on the right shows what a completed spreadsheet might look like. Red numbers at the bottom mean you spend more than you earn during that period. Red numbers must be eliminated in a budget by either eliminating spending in a discretionary category or taking steps to reduce the amount of a mandatory expense. The next slide shows you how you might simplify this detailed information. All the numbers in this example are not intended to be realistic, but the chart shows you how you might group some of your expense details together. This might be a budget for a single person or a couple with income from a full-time job and a part-time job, and you can see the expenses are grouped into the mandatory and discretionary categories using the Y and N from the previous step. You will have more mandatory items than shown, like gas and insurance for your car. After subtracting the mandatory expenses from total net income, the remainder is what is available for emergencies, possible savings, and for discretionary expenses. We would put car repairs under emergency expenses because, like any other emergency, the timing is not predictable. All emergencies become mandatory expenses when they happen, and all emergencies must be paid from either savings or by giving up discretionary spending. Sticking to a budget requires personal discipline and self-control, meaning saying no to your own impulses. It also requires a method of knowing how much you have already spent each month. Having a budget is essential to managing credit debt, which we'll discuss next. At the most basic level, there are two types of credit for consumers: secured credit and unsecured credit. When a bank loans money for a car purchase, the car is pledged as collateral against the loan. The bank holds the title until the borrower has paid off the car loan and then releases the title to the borrower. If the owner fails to make payments, the bank holding the title can repossess the car and sell it to recover the unpaid remainder of the car loan. These loans normally have lower interest rates because the risk of loss for the lender is lower. They also have fixed monthly payments for a specified period. Store credit cards and bank-issued credit cards like Visa and MasterCard have higher interest rates than loans secured by collateral. Monthly payments vary based on the balance and will normally have a minimum payment each month based on the balance. Large installment contracts, like for home renovations, will have fixed monthly payments, and student loans will have a deferred start date for payments, but interest still accrues from the original loan date. Whenever you use credit from banks or stores or any lending organization, they report your payment history and loan balance to the major credit reporting agencies like TransUnion, Equifax, and Experian. Those agencies use a formula to calculate the score, which they provide to all lenders. Your credit score reflects your financial reliability as a borrower and comparative risk to the lender. Your credit score determines whether future lenders will extend credit to you. It affects the interest rate you are charged and even influences your car insurance rates. At the bottom of this slide, you can see the components that are used in the formula to calculate your credit score. You need to know whether your score is good or bad. So let's look at that. Credit scores range from 300 to 850 and are derived from risk models developed by two agencies, Vantage Score Solutions and Fair Isaac Corporation, or FICO. The big three credit reporting agencies, Experian, Equifax, and TransUnion, use Vantage Score, while other smaller reporting agencies tend to use FICO. The number indicates the risk of default on a loan. The higher the number, the lower the risk. While the two scoring models have the same bottom and top numbers, their assigned risk categories have slightly different breakpoints. If your score is near one of the breakpoints, I really don't know what the effect might be. What is important is that you know what your score is. It doesn't change quickly, but it does change over time. So checking it every 3 to 6 months is good practice. If it suddenly drops and you know you haven't missed any payments or had late payments, you need to investigate to find out the cause and get it fixed. Every adult needs a good credit score, even when they aren't making payments on credit cards or loans, because they eventually will need to make a major purchase, like for a car or a home. Here are some tips for building a good credit rating and score. If you have a bank or store credit card, use it the same way you use your debit card. Pay the entire balance every month. If you do, you won't have any finance or interest charges to pay each month. If you can't pay it all off, try to pay more than the minimum monthly payment on the bill. If you do, you will pay off the balance sooner and will pay less interest on those credit card purchases. If your score is considered fair, low, or poor, you can rebuild your score, but it takes time and dedicated effort. Don't leave it until you need to buy your next car. Ask for help from someone with experience in this area. Do you remember at the beginning I mentioned the Japanese philosophy of Kaizen? And one of the tenets is you cannot control what you cannot see. Having a methodical way of tracking your spending is the only way you can control your spending. Since most spending is through a checking account, we'll focus on tracking income and spending in that account. It's called a checking account because people write checks to pay for things, although the invention of the debit card has greatly reduced the number of checks written. A checkbook holds a pad of checks and a paper booklet or ledger to record each deposit, cash withdrawal, and payment as they occur. If you remember the earlier slide showing the time delays between payments and bank processing, the wonderful aspect of the ledger is that you understand the money is gone the moment you write the check into the ledger because you adjusted your available balance with every entry when it occurred. You will never have an overdraft or bounce check, or insufficient funds notices, or rejected debit card transactions, and there will be no penalty charges for those things from the bank. A second line in the ledger entry is used to record what this is for. In the next slide, you're going to see why that helps you too. There are several money applications in the market that have been around for a while and have useful features, but there are pros and cons with all the apps. All of them can help you set up a budget and provide you a digital ledger to enter your income and spending. And like the paper ledger, all enable you to see transactions that have not been processed through your bank account. All of them have functions to remind you of upcoming scheduled expenses, but none of them can categorize your expenses properly because they are dependent on the merchant category code, not what you purchased. Retailers like Amazon, Walmart, and Target that sell almost everything still have only one merchant category code. Your bank's app on your cell phone is virtually useless because it can only show you banking transactions as they process. Viewing money apps on a cell phone is like looking at your finances through a straw. Laptops and desktop computers enable you to see a more complete picture of your finances in a single view. The most critical point I want to get across is in the gold banner at the bottom. Once you get into the habit of putting everything into a money app, you can always look back to see what you did months ago and even years ago. It's more trustworthy than your memory. The most effective way to track your money and exercise control over your spending is by using a personal money application like Quicken Desktop Classic. I've been using Quicken on my home desktop computer for over 30 years. As you can see, the checkbook ledger in Quicken looks quite like the paper checkbook ledger we saw a few slides back. You enter the date, whether it's a deposit, debit, or check. Enter the business name, amount, select an existing spending category or create one, and enter a memo. Quicken does all the math. There are other money tracking applications out there too, but I recommend Quicken because it seems to be the most intuitive user experience, and it has the best reports available while handling all types of accounts like checking, savings, loans. When you enter your data into a money app, you are writing your own financial history. My data is stored on my personal computer, not in the cloud, but I do have it backed up. Being able to see how your spending behavior changes over time is critical to gaining control over your finances, and you'll like that feeling. I guarantee it. On the right, you can see a portion of the Quicken Standard Reports menu with arrows to the most commonly used reports. Newer versions of Quicken will probably look different. The popular cash flow report displayed here is where you can see a summary of the deposits into your bank account and also see a summary of how you spent your money. At the bottom of each column, the cash inflows minus cash outflows equal net cash flow. If your net cash flow is red, as shown here for January and the totals column, you spent more than you deposited, and you paid for some of those expenses using savings or credit cards. The report also allows me to see how my spending in a category changed from previous months or from one year to the next. I can even see how much the wife spent on clothes or the last time we went to a particular restaurant. If anyone asks you where the money all went, with a money app like Quicken, you can confidently say, I know where it all went. Some things you can't change, like rent, but you can change your spending on other things when you can see the difference that change would make. So, we've gone through 4 aspects of managing your personal finances. In banking, remember that what you see online is the sequence of deposits and purchases as they process through the interbank network and are posted to your account. What you don't see, the transactions still in the digital pipeline, can hurt you if you don't remember they are there. We defined a budget as a plan for controlling your spending based on your expected income for a specific period of time. We showed you a process for building a budget for yourself. In the example budget, you saw how mandatory expenses must have priority over discretionary expenses, and knowing the difference is critical to controlling your spending. You saw how important credit and your credit score is to your quality of life. Know your score and protect it for that time in the future when you will need something important. Finally, tracking your spending is absolutely the most important habit that requires dedication and commitment. Use a money application like Quicken to write your financial history and use the reports to see how you are doing. Remember Kaizen, you cannot control what you cannot see, and a money application will enable you to see and control your spending. I hope this video has helped you understand the concepts for managing the major aspects of your personal finances. Implementing these concepts will enable you to gain and maintain control over this aspect of your life. If you found this video useful, please hit the like button. And thank you again for watching.